A very good morning and welcome to GoToWebinar Control Panel and the FX Week Ahead Live Market Analysis with myself, Giles Copkin, Chief Currency Analyst. Hope everybody's doing well. Good to see some good names here. Good to have you, Gary, Georgie, Jabin, Johan. Great to have you. Richard, Milad, Sina, Stefan, good to have you all here. If you could just make sure you can let me know you can see my screen and hear my voice. You just jot that down in the Q&A panel. That would be super. Yeah, thanks, Johan. Excellent. Very good. Just going to give folks 20 more seconds or so to sign on in. And just as we're waiting for people to come into the webinar, just don't forget, as we talk about different entries, exits, different trade ideas, the whole idea of this webinar is that you look over someone's shoulder from a professional trading perspective and you see how I go about making trading decisions. The whole idea of this webinar is not a signal trading service, but an educational one, just in case anyone's confused. The regulars know what we're looking at. These are the key topics I'm going to be covering, as well as looking ahead to what's coming up. We're going to be looking at what's going on with the US dollar. Absolutely crucial to be on top of the dollar as we start the year. We're looking at gold. We've got some very strong seasonals for gold. I'll explain why they're not working at the moment. Also, we'll be looking at China's COVID-free policy, why that's a big risk, tail risk for markets, as well as looking at the New Zealand dollar yen, and looking at oil's outlook, as well as the main risk for US stocks in the short term. So without further ado, got a lot to cover, so I want to get stuck straight into the webinar. Now, what I want to do is just explain to you the tail risk that's going on. Now, I'm taking these charts from part of my role where I work with Financial Source. That is a resource that is available to HYCM clients. So if you become an HYCM client, you can get access to the Financial Source analysis and charts, and I am one of the key senior analysts there. So I'm just taking that from Financial Source. Now, if you just take a look here, if you look at the turquoise line, that's the increase in Federal Reserve interest rates. If you look at the green line, that's the rise in US stocks, the S&P 500 index. So what you can be forgiven for thinking recently. We've seen the Nasdaq. You look at the Nasdaq recently, and we suddenly saw the Nasdaq falling quite significantly last week, didn't we? If we just take a look here at stocks, let's just go over to the. We'll get there in the end. We will get there. Yeah. If you just take a look at the Nasdaq, the Nasdaq has fallen quite significantly to start the year. Now, you can be forgiven for thinking, well, as 10-year yields have been moving higher, it's the move higher in yields which drags equity markets lower. No, it's not the case. It's the disorderly move in bond yields which is dragging equity markets lower. Because what equity investors are fearing is that the Fed is going to be hiking interest rates into slowing growth. Okay, now if growth continues, then the stock market can keep rising. So you can see here, even as the Fed were hiking interest rates, you see how the S&P 500 kept gaining. So what's significant here is not the fact that the Fed's hiking interest rates, it's not the rise higher in yields, it's the fact that the investors are thinking the Fed's hiking too fast, too quickly. And we've now seen Goldman Sachs saying that they project 4 interest rate hikes this year because the Fed will have to be responding to rising inflation. Now, a couple of things to look at. Earnings seasons really kicks off this week. And if you see the earnings for JP Morgan, BlackRock, Wells Fargo, Citi, some huge investment bank names there. If earnings stay robust, there's no reason why the equity markets can't keep rising higher. Now, one of the things you have to be careful of, particularly as a retail trader, and particularly if you follow Twitter, the amount of very bearish news there is on stocks, it's really quite overwhelming. Now, don't get me wrong, the outlook in the near term is bearish for stocks. We've seen a bit of risk-off trading coming in, seeing a bit of yen upside. Look, that's a bearish engulfing bar. Wouldn't be unreasonable to see a move down from market prices down to that sort of 4609 region. Wouldn't be unreasonable to expect that. If we just take a look here, 1, 2, 3, 4 touches, that's a trend line. This upside trend line is still in place. And if you take a look at the S&P 500 across the months, you see how markets tend to move from the left to the right. Stock markets are sort of permanently in a bullish market, essentially. Now, that's not to say they can't correct. It's not to say they won't correct. It's not to say there won't even be a correction now. But what I'm wanting you to understand is that if the correction comes, it will be on 2 things. 1, slowing growth, as demonstrated by a drop in earnings. Two, it will be the Fed is hiking too fast into slowing growth. Now that's what happened in 2018 when we saw some heavy falls in the NASDAQ and US stocks around the turn of 2018, 2019. Stocks sold off because markets were fearing the Fed was going to be hiking into slowing growth. Exactly the scenario that we're being frightened of right now. Now, whether that happens does remain to be seen. We're in the kind of twilight zone where we're trying to work out what the latest information is. Also, to help us, you can see here the balance sheet is the light blue line. As the balance sheet was tailing off, okay, plus the Fed expecting to rise interest rates more aggressively, resulted in stocks moving lower. Okay, now the expectation again is that the Fed's balance sheet is going to be dropping again. And the last minute suggested that could be more quickly than the market was expecting, to be as soon as March, possibly, some commentators and analysts are saying. So when the last interest rate hike, when the first interest rate hike has come, some people say the balance run sheet could begin there in March. Goldman Sachs, for instance, say it's more likely to be July. And I think a later start would make more sense. But having said that, this is what's interesting. So if the balance sheet starts, investors are concerned the balance sheet is running off, and it's the rise in the balance sheet that supports stocks. You can see when balance sheets increases, that supports stocks. When balance sheet falls, you see stocks move more like sideways. Rising balance sheet, rising stocks. Rising balance sheet, rising stocks. So if balance sheet starts to fall off, the Fed's expected to hike more quickly and growth slows down, that's what will be the move lower in stocks. So that's the understanding. Okay, if you've got that, you've now got the understanding of what's going on. Essentially, they're the big pictures, big picture issues. Okay, now with that being said, take a look at the VIX. The VIX is always a good indicator, and the VIX is trending higher. So the VIX keeps moving higher, trending to the upside. That does indicate falling downside in the S&P 500. If you just take a look at the volatility of the bond index, that is thankfully dropping a little bit lower. But if you just put the S&P 500, onto this chart, we just do a quick overlay here again, using my role as financial source senior commentary analyst. You can see that when the VIX rises, you see downside in its stocks. Okay, rising VIX, falling S&P 500, rising VIX, falling S&P 500, rising VIX, falling S&P 500, rising VIX. What does that say? There's a continuation of further falls in the S&P 500. Okay, so that's where we are now. What's just happened is there's a bit of risk-off trading going into the market, and if you just take a look here at the recent currency space move, if I just show you the recent moves in currency space, you see here. So this is currencies starting from today. You can just suddenly see the yen has been gaining in strength, by minute essentially. See yen strongest, Swiss franc weakest. Now the Aussie CAD New Zealand dollar started off the session quite strong. You can see where the Aussie was here strong alongside the CAD strong alongside the New Zealand dollar. So at one stage 740 markets were tilting risk on. You see had in terms of the FX space, CAD, New Zealand dollar, Aussie upside. That's just retreated a little bit lower. Now, the yen is now finding some strength and some risk-off flows. What's the reason? Well, there's some more Omicron cases found in Tianjin. Okay, that's a gateway city in China to Beijing. If Beijing gets Omicron and you start to see Beijing being hit down, that's significant in terms of risk. So the thing to be aware of is this. If China sees a rise in Omicron cases, it's serious for China because they will lock down entire cities. They have what's known as a zero-free COVID policy. So they're looking for total eradication of COVID, and the way they achieve that is by locking down cities. Now that is terrible for growth. If we start to see lots of cities being locked down in China, then markets are obviously fearful. Now in the medium term, I think this is a dip to be bought, okay? So in the medium term, the best opportunity I can see is if we start to get some of these risk sensitive pairs, like the New Zealand dollar, Japanese yen, drifting lower down into that key support level around that 76.50 region. Now, if you just take a look at the bond yield spread between New Zealand 10-year and Japanese 10, do you see how the bond yield spread's moving higher? Okay, but the New Zealand dollar Japanese yen pair is moving lower. Why? It's moving lower for the simple reason that we're seeing some safe haven flows into the yen. Now, medium term, I'm expecting this pair to move higher. So any drops down to that 76, 75 region can be considered suitable for going long. Okay, so here's the two ways in. One, expect buyers around that region. Stops can just be run the other side of 74, around 73.90, looking for a move back up to 82 and beyond. So if we start to see this is a false break, so if we see buyers start to stepping in here, this is a false break of Harami inside bar, and we close above the previous day's candle, then that's suitable to go at market at the end of the day. Stops just below the recent low. Now, the interesting thing about this pair is that the Reserve Bank of New Zealand, they project to raise interest rates to 2.6% by the end of 2023. So in other words, they're expecting to go on a very large interest rate hike profile. They're currently 0.75%, so they've got to go, you know, what, just short of 200 basis points higher. When a central bank raises interest rates, that supports the currency. So you can see the New Zealand dollar has been supported, should be continued to be supported. Bank of Japan have very low interest rate differentials. You look at the yield spread, look, it's pushing higher. This pair is a medium-term buy. So, you know, if we get back down to that 75, 76.50 region, that is suitable for going long in the pair. Now, looking at we'll look at gold as well quickly. Now, gold has some very strong seasonals at the moment, very, very strong seasonals. They're not playing out because of this move higher in real yields. Now, let me explain what's going on with gold. Like, this is gold overlay with real yields. When gold falls, right? You see the gold, when gold falls, it's when real yields and the dollar's moving higher. What's real yields? That's the nominal bond yield minus inflation expectations. So when real yields surge higher, look, do you see how real yields are surging higher? And the dollar also moved higher to start the year. That's what's been pushing gold lower. So unless we see real yields push lower and the dollar push lower, then expect gold to remain pressured. The seasonals for gold are very good, a very strong upside. Haven't got time to look at them now. Do check out my blog, and you can, have a little look at that. But that's what's happening with gold at the moment. So I still favour near-term downside in gold, despite the strong seasonals. Just take a look at my blog here and just search gold, and you'll see plenty in the HYCM lab, and you'll see plenty of opportunities there. Okay. Oop, I'm just going to send this to everyone. That's my blog there. Now, one point I wanted to make to you is this. Sometimes when you're not certain, it's best to trade less. As we start 2022, there's a lot of uncertainty, so don't end up like just getting into trading and trading too much. So do check out that article I've sent you. I do think there's an opportunity to trade less. I do think that New Zealand dollar yen upside medium-term bias makes sense. But I think you have to be very careful with so much change and so much uncertainty in the markets right now. Now, let me explain what's going on with the dollar. Now, the dollar has been moving higher into the fourth quarter of 2021. Why? Interest rate hike expectations from the Fed. Okay, we've seen the dollar moving higher. We've also seen US 10-year yields moving higher. And as the 10-year yields have been moving higher, that's been supporting the dollar, particularly from the fourth quarter, right? Now, 10-year yields are moving even higher. The Fed's expected to hike 4 times this year by Goldman Sachs. Fed fund futures are pricing in 3 interest rate hikes. The Fed project 3 interest rate hikes this year. But yet the dollar is being pretty range bound. Why? A lot of that good news is already priced in. Now, a couple of things. One, don't forget the dollar can operate as a risk-off currency. If we see more risk-off trading, more yen strength, expect the dollar to also strengthen. If we see we'll look at CPI data, but if we see more expectations but more aggressive Fed action, that should support the dollar. The best opportunity is if we see reasons for dollar weakness. I'll tell you why. Because a lot of that dollar strength has been priced in. Okay, so that's been priced in because it's been expected for a long time. You can see, look, nearly 80% chance of a March hike expected, 14 basis points away from pricing 4 hikes by December, the Fed Fund futures. We'll look at the core CPI print in a minute, and I'll explain to you what the trade is with that. But the best opportunity does rely on there being a big miss. Now, today's very, very light data front. There is a bond auction coming up, and just need to check out that. If we see a lot of demand for bonds, then that can result in some dollar yen downside, okay, because yields will push lower. So if we see very good demand for bonds, 10 years of just 1.8% plus, then that should support more downside in dollar. If it's a poor bid to cover ratio, then look for yields to rise, and that should be more strength in the US dollar. So just watch out for that. Now on Tuesday, we've got Powell speaking, and we've got Brainard speaking as well before the CPI data. So watch out for the Fed speakers, particularly look out for their opinion about what's happening with Fed interest rate hikes. The main event of the week is going to be the CPI data point. Now, at the moment, core CPI year on year is expected to be 5.4%. The headline CPI is expected to be 7% year on year. So if we see inflation print very, very high, this is how to trade it. So if it comes in really high, then we're just going to expect a little bit more dollar strength, but we're not expecting that dollar strength to keep coming on. You might see a dollar sell-off. Why? Because look, 3 hikes already priced in. Is 4 hikes really realistic? Even if inflation is a bit higher, markets are still expecting inflation to keep going up. Like we started to see last week a bit of inflation pressure dropping because we saw manufacturing prices paid just falling. Okay, so we saw US CPI data. We saw the prices paid just moving lower. That means that the prices that manufacturers pay for their raw materials was dropping. Now that should mean inflation should drop, but you know, expectations are still, look, 7% for year on year and 5.4% for year on year core CPI data, so it's above the prior reading. So the market's still saying we haven't reached peak inflation yet. So we need to watch out for that. So the best opportunity on Wednesday is if we get a miss. So if the US CPI is below the market's minimum expectation, so if you look on the month-on-month, you can see the minimum expectation is 5.3. If it's below 5.3 for the month-on-month, and the year is 6.6. Now, the Fed prefers the core, so look at the core. So if the core comes in like below 5% or below 5.3%, expect a lot of dollar weakness. So in that case, Euro-US dollar upside makes sense. Look out for that on Wednesday, okay? Missing the CPI, month on month, look for Euro-US dollar upside. That is a key opportunity, and dollar downside. So you could also look for New Zealand US dollar upside, Aussie US dollar upside, depending on what's happening with the risk tone, okay? Dollar yen downside is possible. My favorite pair would be the Euro-US dollar upside. Now that is if we got that on Wednesday. Best opportunity of the week is coming here. Inflation is so, you know, I was speaking to a group, I think it was Benzinger.com in the US, right? And they were speaking to me on inflation for 40 minutes on inflation, 40 minutes just on inflation. You know, they didn't want to know anything else, but all they want to know about inflation. And that tells me a lot. It's a US company, US based. Inflation is a massive politicized issue in the US. You know, the fact that, you know, a news media communication will be, you know, that long on inflation tells me everything I need to know. So inflation is a core focus of many investors, and it's become politicized. So look out for volatility there. PPI, again, look out for producer price index. This could have a similar reaction to the CPI print. If we start to see PPI dropping even lower, that should see some dollar weakness because it just takes the pressure off the Fed. So again, Euro-US dollar upside would make sense. Conversely, obviously, if we see these beats and they're coming in strong, then we maintain the status quo, but it's not an obvious tradable opportunity. Friday, we've got retail sales out of the US. That factors into the question of how much does growth slow. And we've got the financials. Now, financials tend to do well when interest rates are expected to rise. Why? Because more interest rates means banks can charge more on their loans. They tend to be more profitable. So that's potentially good outlook for the financials that Goldman Sachs, BlackRock, Citi, et cetera, who have earnings released on Friday. But do look at these for the first sense of, well, how's earnings doing? Remember what I said, that as interest rates increase, stocks can still rise as long as earnings stay robust. And the first indication of those earnings will come in on Friday, okay? So as well as the retail sales, we're going to get the earnings. So expect those two to change the risk sentiment. And look out how the US consumer is doing. Remember, you know, the US is a consumer-driven economy. So that means that what the consumer is doing is incredibly important. The US has the largest GDP of every country in the world. About 25% of everything produced in the world comes from the US in terms of the GDP, hugely wealthy country. And the majority of those earnings come through salaries and wages. And of course, the expression of how the US consumer comes in through retail sales. So this is a hugely important data point and will give us an indication of the health of the US consumer and by proxy the US as a whole. So markets will be focusing on that retail sales data to get a sense of how the US is doing. Any hint of a slowdown, remember what I was saying, then we could expect to see potential falls in stocks. But we've got to factor in medium term, still upside bias, but if we start to see earnings slow, we start to see the US consumer struggling, then this current selling in stocks that we're seeing right now could well accelerate, okay? So that's what we have to be aware of. That is a really good overview of where we're at. And you should have a good understanding where we are at with the market. You can see that risk, you know, some of these risk negative, positive pairs moving lower. That's great. That New Zealand dollar yen, look, as that's drifting lower, the bond yield spread's moving higher. That bodes well for the New Zealand dollar yen medium term. Can you see how closely the bond yield spread tracks price? Do you see? When the bond yield spread moves higher, so does price. When the bond yield spread moves lower, so does price. Lower, lower, higher, higher. You see? Right? So now we've got a divergence. We've got price moving lower. We know why. Yen's being bid on risk off flows at the moment due to Omicron concerns. Bond yield spread moving higher. One will catch up the other. Price will eventually should catch up to the bond yield spread. It's just a question of defining, limiting your risk, so that if you are wrong and if this level breaks, you know, where's your stop? You know, and if price keeps moving lower, then that's even better price. But you need to make sure you're not using too much leverage. You're managing risk so that you've got opportunity to take advantage of that turnaround if and when it comes. Folks, it's been a pleasure. Real look forward to it. Don't forget, back here on Wednesday for another workshop. I have to dash now. I'm very sorry. I have another webinar with an organization called Forex Analytics. So do take a look at my Twitter feed, and you can see that there. My Twitter handle is @JarlesCoplandCCA. I'll just put that there. If you're not following me on Twitter, do. Yeah, Stefan, OPEC, sorry, I will cover that very quickly. I'll just put my Twitter feed on, then I'll quickly cover OPEC and explain what's happening. That's my Twitter feed, my Twitter handle. I'll show you it as well because I've got to go back to the other screen. Sorry about that, Stefan, and thank you for the reminder. Let's move to, that's it. So there's my Twitter feed @JarlesCoplandCCA. And here's what's going on with OPEC and oil. Now, what's going on is very, very simple. Okay, you can see oil prices, they are sort of in this range at the moment. Now, what happened is OPEC met last week and they supported the oil markets because they see demand picking back up in the first quarter and second quarter of this year. So that supported oil prices. We also had, do you remember Kazakhstan, those terrible difficulties they had, and Libya? So there was reduced supply in the market last week as well. So OPEC was reassured. They went ahead with their production cut of 400,000 barrels, their production increase of 400,000 barrels per day, right? Now the market took that as positive, saying, well, OPEC are obviously quite confident that oil demand is going to stay. So we bought oil, Libya, Kazakhstan, they've got less supply coming out, that's supportive for oil. But if inflation falls, many are expecting inflation to fall, that's usually a negative for oil. Also, if Omicron surges, that's a negative for oil. Can oil keep pushing higher up into that 85, 86 region? Most economists expect oil to drop lower now. That's not saying it will, but because inflation is expected to peak, because interest rate hikes are coming to control inflation, because the situation for oil demand is expected to boost, so the fact that countries are beginning to open up in some quarters, all of that should be weakness for oil. My opinion on oil is I'm quite neutral. So yeah, I'm favouring downside. I'm certainly not favouring dip buyers. If you were dip buying, just use very key levels. And if you are selling, use very key levels. Stefan, hope that helps. That's a quick rundown on OPEC and what's going on. Take care and have a very good rest of the session. Don't forget, back here on Wednesday at 12:30 GMT. Have a very good day. Thank you all. Goodbye.